I want to quickly talk to you about S corporation tax mistakes you cannot afford to make. And in today's conversation, here is an overview I want you to pay attention to. So let's talk about the common pitfalls to avoid in S corporation taxes. First of all, electing to become an S corporation too late. So the thing is that the IRS the IRS offers a narrow time frame for businesses to elect to become an S corporation. And so a Form 2553 must be filed by the 16th day of the third month of a corporation's tax year. So remember that, the 16th day of the third month of a corporation's tax year. So if you have launched a new business during the course of the year, you have a 75-day time limit that begins from your first day of operations. But if you miss this deadline, you can still apply as long as you enlist the help of a certified public accountant, an enrolled agent, or a tax attorney. Okay, so if you are interested in S corporation tax benefits, don't wait until tax season to apply for a change when it comes to changing your business status, because it may not be possible. So do not be late. So electing to become an S corporation too late is one of the first pitfalls that we have seen in our research when it comes to S corporation taxation. So remember, Form 25.3, this is really important. And so if you actually file late, the election will apply for the next tax year. So where you can demonstrate a reasonable cause for filing late, you may be able to make the election apply for the current tax year, but you need to make sure that you follow what the IRS calls the documentary requirements. This is number one. So number one, not actually electing to become an S corporation too late. Number two, not separating personal assets from company assets. Okay, so as you begin to prepare your S corporation taxes, it's important to avoid commingling your personal and corporate transactions. So business owners, especially those who have S corporation, those who are shareholders of S corporation, should not pay for personal obligations out of corporate funds. It is also strongly suggested that personal and corporate debt be kept separate. So what I'm trying to say here is that you want to have a checking account. You want to have a business checking account that is separate from your personal checking accounts. You want to have a business credit card. You want to apply for a business loan. You want to apply for a business line of credit. You want to have a net 30 account. So you want to have everything that really shows in appearance and in reality that there is a segregation of assets, not only from your business, but also from your personal assets. So this is really important. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. The third thing is shareholder employee compensation. So many S corporations have a shareholder employees who own part of a company but also work there, right? So even though the part owner of a small, let's say the part owner of a small business might not take a regular paycheck, IRS rules that you need to have something called a reasonable compensation. So basically, an S corporation must pay a reasonable compensation to its shareholder employees. And since tax issues may arise for shareholder employees who do not receive a yearly Form W-2, it's really best to pay them in the same manner as all other staff members. That way, you keep everything clean. And so it's important to have reasonable compensation. So if you don't have reasonable compensation, you are going to get in trouble. This is really important. So to actually figure out what reasonable compensation really means, there are a couple of factors that the IRS wants you to take into account. So for instance, does your position require training? How much time and effort is required for this position? How much experience is typically required for this or similar positions? What are the going salaries for this or similar positions? You can go on sites such as you have like a Glassdoor, for instance, or salary.com to sort of have an idea. You can even go to the Department of Labor. Like they have a database that really shows you what kind of compensations are going on right now, and does the position receive any non-salary bonus payments? So this will help you really understand what kind of situational analysis you need to make to determine what is called a reasonable compensation for your specific industry, for your specific niche, and for your specific location. Because see, if you work in California, if you have an S corporation in California, your reasonable compensation is not the same as if you were, let's say, somewhere in Delaware, Newark, Delaware, for instance. Okay, so different geographies call for different sort of compensation levels. So this is really important to keep in mind. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about S corporation tax mistakes that you need to avoid if you want to actually stay out of trouble and also to save money as well. Another pitfall that we have found in our research is shareholder loans. Okay, so for tax purposes, it's also very important to document all shareholder loans, whether the loans are to or from your company. They need to be accounted for prior to filing taxes. So you want to document shareholder loans with a promissory note, which it really includes repayment terms and agreed upon interest rates. And those interest rates might actually they have to be similar to what the market is currently offering, because otherwise the IRS will think you're really disguising loans as gifts, or gifts as loans rather. Okay, so you want to really do everything properly. You want to document properly. You want to keep paperwork in terms of all the payments. If the payments are on a monthly basis or on a quarterly basis, you want to document everything. Okay, there has to be a loan agreement. So the whole thing is there has to be some kind of clean cut loan that is actually that is agreed upon between the shareholder and the S corporation. Another pitfall is poor credit financing reporting. So this is a great mistake we have seen in our research for the last 20 years. So another common S corporation taxes mistake is poor credit financing reporting, which basically causes shareholders to pay more in personal income taxes. And the thing here is that S corporations may take out loans and lines of credit in the name of their business, but this does not result in the most beneficial tax return savings. Instead, it is a smart strategy to borrow money directly from the bank and then provide a loan to your company. So it's one of those things. If you have questions about this specific sort of tax scheme, let us know in the comment section, and one of our team members will get back to you. We'll certainly explain. It's a little more convoluted. I don't have time to really spend 20, 30, or 40 minutes to explain everything here about poor credit financing reporting. But if you have questions, if this is a topic that really sort of is near and dear to your heart, let us know in the comment section, and certainly we'll get back to you. But please, when you reach out to us, let us know your city and state, so we have a clear idea about your geography and also your niche, so we can certainly provide the best answer to your question. Another pitfall that you need to really think about is lack of sufficient net income. So as a pass-through entity, the S corporation is used to avoid double taxation, which really occurs when taxes are paid twice on the same income, right? Now, an S corporation doesn't pay taxes on net income, sales minus expense rather. But because of this, some business owners may try to game the system, reporting little or no income at all to avoid paying taxes. So to avoid IRS suspicion, make sure you are honest with your numbers. But what if your business operated at a loss for the year? That's fine. So, operating at a loss can have unexpected tax consequences when the shareholders do not have sufficient stock and or debt basis. So when a loss is realized without sufficient stock and or debt basis, the shareholders may have additional income to report subject to capital gains tax. And so this is kind of important to really make sure, because if you have a business, chances are the business is there to actually generate income. So if you have like 1 year, that's fine. But if you have 2, 3, 4, 5 years of losses, that becomes a little dubious. Okay. The next thing is that deduct self-employment health insurance premiums. So many S corporation owners miss this particular deduction. So if you pay health insurance premiums for your family, you want to include the amount paid by the company as wages in box 1. So you need to include that amount. And so this allows you, for all intents and purposes, to claim this deduction, to actually claim this expense as a deduction on your personal return. Just make sure that you don't put this in box 3 or 5 though, because it is not subject to Social Security or Medicare tax. So it's one of those things where when we talk about health insurance premiums, when we talk about self-employment health insurance premiums, we're talking about medical expenses that really help you not only stay healthy, but also making sure that you are taking care of your family, but also you're taking care of your taxes. So this is a great deduction that a lot of S corporation shareholders really miss. And one thing I want to say here is that the best way for you to actually find out is to actually take a tally. You want to take a note of all those miscellaneous expenses that you could actually save you a lot of cash come tax time. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about S corporation taxes and some of the pitfalls you need to avoid in when it comes to S corporation taxation. Now let's talk about another pitfall. This is the home office deduction. You got to use that deduction wisely, okay? So even pre-pandemic, more and more business owners were realizing the benefits, lower overhead of working from home. So if you did work from home in an area exclusively designated for work and haven't claimed for a home office, you are missing out big time, big time. So what you want to do here is that you want to take the square footage of your home office and divide it by the square footage of your home. And so this will be the percentage of household expenses. So we're talking about utilities, home insurance, mortgage, cleaning, and so forth that you can write off. So, but please be honest here, okay? Be honest and be straightforward with the tax man. You do not want to get greedy. You want to write off your den for sure, but do not pretend your bedroom or washroom are part of your home office, even if you came up with your best business ideas there, okay? So you got to be just realistic. The next thing is you want to make and follow your accountable plan. So unlike wages and a reimbursement for expenses employees incurred in the course of their employment are not taxable. So by creating an accountable plan, those reimbursement will not be treated as wages and can be deducted as business expenses. So an accountable plan contains the guidelines developed by you that will explain which expenses qualify for reimbursement and how you will reimburse those expenses. So an accountable plan will provide you leeway if, say, you needed to use your personal credit card to make a business purchase or incurred some other legitimate business expense. And your accountable plan guidelines must show a business connection. So the expense must be incurred in the course of business or employment, must be documented. So you will need documents to show what the expense is and how it relates to the business/employment. It must be substantiated. So you will need supporting documents such as mileage log or details of an entertainment expense with the who, where, and why, and must also ensure no excess payments. So we're speaking here about if your guidelines allow you to advance expenses and there is an excess amount after let's say validation, it must be returned, or else the excess amount will be treated as wages. So technically, there's no rule saying that accountable plans must be in writing, but it makes sense to do so. After all, it should be clear and accessible to employees and will be a lifesaver should the IRS question expenses the company reimburses. One thing I want to say here in number 10, you want to be smart about credit financing. So it's really important to understand that like any other business enterprise, an S corporation may get loans and lines of credit from financial institutions. And it may seem really simplest to make these arrangements in the name of your S corporation. But as I said earlier, if you can get a better tax return saving, better tax return saving by borrowing directly, do it. Okay, if you borrow the money directly, then provided a loan to your S corporation. If that sort of arrangement really is great for you, do it. This way, because the S corporation tax liabilities and credits pass through to you in capacity of you as a shareholder, any interest payments, for example, associated with the loan also go to you, so you don't end up paying more personal income tax than you need to. Now, the thing here is that when we talk about this scheme actually applies to all kinds of financing. So we're speaking about a line of credit, of course, a business line of credit for your S corporation, a business loan for your corporation. In some cases, so all kinds of S corporation financing. So merchant cash advance, for instance, you have line of credit, you have a loan, you have equipment financing. And so you have all kinds of, and in some cases, even if you have a no doc business loan, if that works, if you get a better deal, go ahead and just, again, take out the loan in your own name. Now, the only thing is you need to have good credit for it. If you have good credit, then go ahead. But if you have like if you have average credit, I wouldn't really advise you to do that, because by doing so, you are lowering your credit score a lot further, which could be bad for you in the long run. So you only want to apply this strategy if your personal credit, not business credit, if your personal credit is already great, so if your FICO score is like above 670 or even 700, then go for it. But if you have a FICO score like around 500 or 550, whatever, don't go with this route. The same applies if you have a payday score. In other words, your business credit score from Dun and Bradstreet that's around the 70 or 75. You still don't have good credit, so you want to not use this strategy. Let me give you the approach you need to really follow when it comes to S corporation taxes. So when we talk about S corporation taxes, you need to understand that an S corporation is very, very flexible, but also very strict. Okay, so it's one of those things where you got to ask yourself, the S corporation status is pretty good for me, but do I qualify? In other words, suppose your business is a domestic corporation with no more than 100 shareholders. In that case, registering as an S corporation could be an excellent financial move. When registered as an S Corp, your business can share your taxation with your shareholders by allowing your income, losses, deductions, and credits to flow through the shareholders first, right? I've already established that. Then what happens here is that your tax return reports income and loss, and so the result, not only are you avoiding double taxation, but you're also saving a lot of cash in the long run. But what I mean by being very strict is that you got to really take care of paperwork a lot. So we're talking about paperwork around receipts, around expenses, around income, all that kind of stuff. I'm not even talking about the reasonable salary sort of element. That's an important element. You got to have the reasonable salary. You got to show the IRS that you're not really trying to game the system. And so reasonable salary is really important. Now, one thing I want to say here is that S corporations are not for everyone. That's for sure. So it's one of those things where you have to ask yourself, am I in the right industry? Do I have the right corporate structure to really elect S corporation status? Do I have the background to be able to, the background, but not only the background, but also the resources to be able to afford maintaining an S corporation? Because an S corporation is not really as convoluted as a C corporation. However, you still have to you have to allocate some resources to make sure that the S corporation status is not revoked by the IRS. So you got to ask yourself, is this for you? Do you have the resources? Do you have the background? Do you have the configuration, the operational configuration to actually set your S corp, your LLC or your C corporation? Do you have that sort of resources to those resources to convert your LLC into an S corp, to convert your C corporation into an S corp, to convert your partnership into an S corp? So you got to ask yourself those questions way before you do the conversion, way before you elect that conversion. Okay, and everything happens through Form 2553. Okay, Form 2553. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about S corporation taxes, the mistakes you need to avoid. So I give you the overview with the top 10 tax mistakes you need to avoid, and then I give you the approach. Thank you so much. God bless you. I'll speak to you another time. Until then, remember, stay marvelous.